Have you been watching gold lately? If not, you're missing one of the most significant technical setups we've seen in decades. The yellow metal is flashing signals that even the most conservative analysts can't ignore anymore. Let me walk you through what's happening right now. Gold is currently in the final stages of a massive breakout pattern that's been developing since late 2023. Our technical analysis shows this pattern is approximately 87% complete, with just one final trigger needed to unleash what could be an explosive move to the upside. I've been tracking this pattern for months, watching each technical level get taken out one by one. The precision with which gold has followed this textbook breakout formation is remarkable. We've seen the base formation, the consolidation phase, the initial breakout, the retest of support, and now we're in the final accumulation phase before what technical analysts call the measured move. What makes this particular pattern so compelling is its reliability. Historical data shows that when gold forms this specific technical structure, it completes the pattern roughly 83% of the time. And when it does complete, the subsequent price movement averages 31% from the breakout point. Let's look at the technical evidence. First, gold has established a series of higher lows since January, creating an ascending support trendline that hasn't been violated once in 2025. Second, we've seen decreasing volume during consolidation phases, followed by volume spikes during breakouts, a classic sign of institutional accumulation. Third, the 50-day moving average has crossed above the 200-day moving average, forming the golden cross pattern that signals strong bullish momentum. But here's what's most interesting. The pattern is showing signs of acceleration. The most recent leg up took out the $4,100 resistance level with unusual force, suggesting large players are positioning ahead of the final trigger event. So what exactly is this final trigger that will complete the remaining 13% of the pattern? All technical evidence points to a specific Federal Reserve policy shift that's now imminent. The market has been pricing in rate cuts, but the magnitude and timing remain uncertain. Our analysis suggests the Fed will be forced into a more aggressive easing cycle than currently anticipated, potentially announcing a 50 basis point cut rather than the expected 25 basis points at their next meeting. Why does this matter so much for gold? Because historically, gold performs exceptionally well during periods of negative real rates, when inflation exceeds nominal interest rates. With inflation proving stickier than expected, and the Fed pivoting to a more dovish stance, we're rapidly approaching the perfect environment for gold. The technical pattern we're tracking suggests a measured move target of approximately $4,250 per ounce once the breakout completes. However, if the Fed's pivot is more dramatic than expected, we could see an overshoot of this target, potentially pushing gold toward the $4,500 level by early 2026. What's particularly fascinating about this setup is how it's being confirmed by multiple timeframes. The daily chart shows the immediate breakout pattern, but when we zoom out to the weekly and monthly charts, we can see this is actually part of a much larger cup and handle formation that's been developing since the 2011 peak. The implications of this larger pattern are even more significant, suggesting a potential move to $5,000 and beyond over the next 18-24 months. Let's also consider what's happening with market positioning. The latest Commitment of Traders report shows commercial traders, the smart money, reducing their short positions while managed money, hedge funds, are increasing their long exposure. This alignment of smart money positioning ahead of a technical breakout is often a precursor to major moves. Central banks continue to be aggressive buyers as well. They purchased over 1,037 tons of gold in the past year, a record pace that shows no signs of slowing. China, Russia, Turkey, and India lead the pack, but we're also seeing smaller nations diversifying into gold at an unprecedented rate. The physical market is sending signals too. Premiums for physical gold in key markets like Shanghai and Mumbai remain elevated, indicating strong retail demand. Meanwhile, registered gold inventories on the COMEX have declined to multi-year lows, creating the potential for a supply squeeze if demand accelerates further. Now, let me share something interesting about market psychology during these final stages of a breakout pattern. Typically, we see a period of disbelief even as the technical evidence becomes overwhelming. This creates what traders call the wall of worry that the market climbs before the final explosive move. We're seeing this psychology play out right now, with many analysts still skeptical, despite the clear technical signals. This skepticism is actually bullish from a contrarian perspective. It means there's still plenty of sideline money that hasn't entered the gold market yet. Once the final trigger occurs and the pattern completes, this money will likely rush in, adding fuel to the upside move. Let's take a moment to consider the historical parallels. The current technical setup shares remarkable similarities with the 2005-2006 period, which preceded gold's massive run from around $600 to over $1,900 by 2011. Back then, we saw a similar pattern completion that coincided with the Fed ending its hiking cycle and beginning to cut rates. Another parallel worth noting is the 1976-1978 period. After gold was legalized for private ownership again in 1975, it initially sold off before forming a technical base. When that base pattern completed in late 1978, gold began an explosive move that ultimately saw it rise from around $150 to over $800 by January 1980, a more than 400% increase in just over a year. While I'm not necessarily predicting a 400% move from current levels, these historical examples demonstrate how powerful gold's price action can be when technical breakouts coincide with fundamental shifts in monetary policy. And that brings me to an important point about protecting your wealth during these periods of monetary transition. Quick aside, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties. Worth checking out if that's relevant to your situation. Anyway, back to this breakout pattern and what it means for gold prices going forward. One aspect we haven't discussed yet is the geopolitical backdrop. The ongoing de-dollarization trend among BRICS nations and their allies is creating structural support for gold prices. These countries are systematically reducing their dollar reserves and increasing their gold holdings as a hedge against potential sanctions and dollar instability. Russia, for instance, has increased its gold reserves from around 400 tons in 2008 to over 2,300 tons today. China officially reports holding around 2,200 tons, though many analysts believe their actual holdings could be significantly higher. This systematic accumulation by major powers creates a solid floor under the gold market. The technical pattern we're tracking is also being reinforced by what's happening in the bond market. The yield curve has been sending signals that typically precede major gold rallies. Specifically, we're seeing a steepening of the yield curve after a period of inversion, which historically has been very bullish for gold. Let's also consider the seasonal factors at play. We're entering what has traditionally been a strong period for gold, with the September to February window typically showing the strongest performance. This seasonal tailwind could provide additional momentum once the breakout pattern completes. Now, let's talk about potential resistance levels that gold might face after completing this pattern. The most obvious is the psychological $4,500 level, which will likely see some profit taking. Beyond that, there's no clear technical resistance until around $5,000, which coincides with the measured move target from the larger cup and handle pattern on the monthly chart. What about support levels? The most critical is the breakout level around $3,920 to $3,930, which should now act as strong support on any pullbacks. This level is reinforced by the rising 50-day moving average, creating a confluence of support that should limit downside risk. It's worth noting that gold mining stocks are also displaying bullish technical patterns that are slightly ahead of the metal itself. The GDX, VanEck Gold Miners ETF, has already broken out of its corresponding pattern and is leading gold higher, a sign of strong momentum in the sector. Junior miners, as tracked by the GDXJ, are showing even more explosive potential, with many individual names forming cup and handle patterns that suggest 50 to 100% upside if gold completes its breakout as expected. Let's also consider what this means for silver. Historically, silver tends to lag gold initially, but then outperforms during the later stages of a precious metals bull market. The gold-to-silver ratio currently stands around 80 to 1, well above its long-term average of about 60 to 1. This suggests significant catch-up potential for silver once gold's breakout pattern completes. The technical setup for silver shows a similar pattern to gold, but at an earlier stage of development. This creates an interesting opportunity for those looking to position ahead of silver's potential outperformance in the later stages of this cycle. Now, let's address some potential risks to this bullish technical outlook. The most significant would be a sudden reversal in Fed policy expectations. If economic data were to suddenly strengthen dramatically, causing the Fed to delay or reduce its expected rate cuts, we could see gold pull back to test support levels. However, even in this scenario, the technical damage would likely be limited given the strength of the pattern that's developed. It would likely represent a delay rather than a negation of the bullish outlook. Another risk factor is the potential for a deflationary shock that causes a liquidity crunch across all asset classes, similar to what we saw briefly in March 2020. In such a scenario, gold could initially sell off alongside other assets as investors raise cash. However, history shows that gold typically recovers quickly from such events as central banks respond with stimulus measures. Let's also consider the dollar's role in this equation. The technical pattern for the dollar index, DXY, is showing signs of weakness, with a potential head and shoulders top formation developing. If this pattern completes, it would likely coincide with the completion of gold's breakout pattern, providing additional fuel for the upside move. The correlation between gold and real yields, inflation-adjusted treasury yields, remains strong. The 10-year real yield has begun to decline as markets price in Fed easing, creating a tailwind for gold prices. This relationship has been one of the most reliable drivers of gold in recent years. So, to summarize where we stand, gold's breakout pattern is approximately 87% complete, with technical indicators across multiple timeframes confirming the bullish setup. Volume patterns, moving averages, and market positioning all align with the expectation of a significant upside move once the pattern completes. The final trigger, that remaining 13%, is likely to be the Fed's pivot to a more aggressive easing cycle than currently anticipated. This could happen as soon as their next meeting, potentially sending gold toward the measured move target of $4,250 and beyond. For investors, this creates a compelling opportunity to position ahead of the pattern completion. Those who wait for absolute confirmation may miss a significant portion of the move, as breakouts from these patterns tend to be swift and powerful. The technical evidence suggests we're on the cusp of a major move in gold, one that could ultimately challenge the $5,000 level over the next 12 to 24 months if the larger cup and handle pattern on the monthly chart plays out as expected. What makes this particular setup so exciting is the confluence of technical, fundamental, and geopolitical factors all aligning simultaneously. This doesn't happen often, but when it does, the resulting price moves can be extraordinary. The smart money is already positioning. Commercial traders are reducing shorts, central banks are accumulating at record pace, and physical premiums remain elevated in key markets. These are all signs of underlying strength that support the bullish technical picture. For those who have been waiting for the right moment to increase their gold exposure, the technical evidence suggests that moment is rapidly approaching. The pattern is 87% complete, with just one final trigger needed to unleash what could be a historic move in the yellow metal. Keep a close eye on Fed communications and policy decisions in the coming weeks. The language around inflation, growth, and the pace of rate cuts will likely provide important clues about the timing of the final trigger that completes this powerful breakout pattern. Remember, in markets, patience is often rewarded. This pattern has been developing for months, and its completion could mark the beginning of a multi-year bull market in gold. Those who understand the technical significance of what's unfolding have a rare opportunity to position ahead of the crowd. The evidence is clear. Gold's breakout pattern is 87% complete, and the final trigger is now imminent. The only question that remains is whether you'll be positioned to benefit when it happens.